Good morning, everybody. And thank you for coming out on this early morning to talk about one of the most scintillating topics that we could be discussing this morning. I also want to take a minute to say hi to anyone that is either joining us virtually or will be watching this via recording. So you may have noticed the camera. If you're watching this virtually or watching the recording, you're missing breakfast. So maybe next quarter, you can do that. I do want to let everybody in the room know, feel free to get up and get more food, more drink, make yourself comfortable. If you need a bathroom, they're right across the hall, out this way. So make yourself comfortable. I'm hoping this is a time where we can share some information, but also don't want it to be too stuffy. Like, you're not going to bother me if you're up and moving around. So, it's been said that we live in a VUCA world. Has anybody heard that expression before? VUCA? Anyone? Any guesses as to what it stands for?
Volatile, uncertain, something.
Yeah, great start. Yeah. So it's VUCA stands for volatility, uncertainty, complexity, and ambiguity. Does that resonate with anyone? Do we live in a world that's a VUCA world? I open the newspaper, and I say that sort of facetiously because I don't really use a newspaper. It's usually on my phone or computer, but I open the news and I see a headline that says that we have the lowest unemployment that we've had in 50 years. And then the next day I open in the news and I see that thousands, tens of thousands of people are losing their jobs and getting laid off. That's
one of those headlines with a lie.
Possibly. And then you see headlines that say, oh, a recession is on the horizon, and then you see other headlines that say, things are looking actually pretty good. And it's really hard to know. In fact, even in our own world, I'll give you an example. My partner Jim and I were just last week in a meeting with the Financial Planning Association, and we're in the meeting, and one of the speakers is talking about alternative forms of investments. And one of their main messages is, you need to look at things other than bonds because, bonds, which had a rough 2022, they're not what they used to be. And so you need to look at other options. And while we're in the meeting, we get like a news flash from Fidelity. Bonds are back. So, this is the uncertain, ambiguous world that we live in. And even the information that we rely on is that way. And so in the midst of this uncertainty, in the midst of a lot of turmoil, as financial planners, our job is to try to bring a sense of calm in the midst of all of that, to bring a sense of peace in times that can be a little scary when you're watching the markets go up and down and you're reading the news. And I have found one of the best ways for us to bring sort of that sense of peace, that calm. And I found this in my professional life. I found it in my personal life, and with my wife and with my kids. One of the best ways to do that is to just provide lots and lots and lots of charts and graphs, right? I'm joking. Charts and graphs. That's what makes everybody feel better. Now, today we are going to go through a lot of charts and graphs. The resource that I rely on for this, there are 144 slides that I could be showing you this morning. Don't worry, I have culled it down. We're only going to use about 140 of them. So I see nobody's running for the doors yet, but you're thinking about it. No, we are going to show you lots of charts, but I'm going to try to whittle it down. I don't want you to get lost in the numbers or lost in the detail. But the charts tell a bit of a story, and I'm hoping to kind of share what are the key themes that we're seeing from some of these charts. The one thing I will tell you right up front, I am not an economist. I love financial planning. And as part of that, we obviously are looking at the investment markets, but, as confusing as the headlines can sometimes be, I'm not going to be able to sort all of that out for you. I don't pretend to be an economist, but we are going to talk about what's going on out there. I'm going to show you some information, and we'll also have some conversation about, what can you be doing about it? Okay, so we're going to start by looking at kind of a history of the S&P 500, in particular in relation to the forward price earnings ratio, or PE ratio. Has anyone ever heard of the PE ratio? Probably, yeah. Fairly common measure. The PE ratio, just think of that as price to earnings. So if I look at an individual company and I look at the stock of that company, what is the share price of that company relative to what it's actually earning, right? At the end of the day, if you're investing in the stock market, what are you investing in? You're investing in a company or a series of companies, and so if you're investing in a company, what do you want that company to do? You want it to give you a return. And in order for it to give you that return in the form of dividends or in the form of a higher price, you want that company to be profitable. You want it to have earnings. So the PE ratio or the forward PE ratio is really just a good way of saying, how is the market valued? And we can compare it to long-term historical averages. So if you look at the chart here, you can see various peaks in the market, various peaks and troughs. And so if you look March 9th of 2009, we all still remember 2008. We still bear the scars of that, even though it's 15 years ago now. The PE ratio at the bottom of that was 10.4 times earnings. Okay. And you can see the run up from 2009 up to February of 2020. And in February 2020, it was at 19.2. Okay. Then we had a steep decline in early 2020 at the end of March. It was 13.3. I sometimes, by the way, have to look at this screen instead of mine because I'm at that age where I need glasses and I haven't gotten them yet. So, and right now we sit at 18.3. So if you look at the chart up at the top here, you can see the first four columns represent each of the different peaks and what the second line there, what the PE ratio was at that time. So 25 in March of 2000, I mentioned at the end of the fall of 2007, right before the market really tanked, it was at 15.1, 19.2, 21.4, and then currently, or as of April 18th, which is when I had to pull this information and get it all approved, we're at 18.3. So how does that compare to historical averages? You can see how that ratio changes with the market, or how the market changes with that ratio, depending on how you look at it. But how has that looked historically? Well, this is the same measure over several periods. So this middle line here represents the 25-year average, which is 16.81. And the two lines above it kind of create this channel. That's one standard deviation above and below. And I'm not going to go into standard deviation. I'm not a statistics professor, and you don't want to hear it. But in essence, what you're seeing is kind of the normal range. And if the 25-year average is 16.81 and we're currently at 18.3, that's I wouldn't say that the market is super overvalued right now. You look over here at this peak, yeah, when it was at 25, that's quite a bit over the historical averages. But right now, I would say the market, because of some of the correction we experienced last year, is pretty fairly valued. And that number can change depending on what earnings are. So we're going to talk about earnings and its impact on that in a minute. So the question is, how predictive is this forward PE ratio? It does give us some sense of how the market is valued, but can it really tell us, well, is the market then going up or down? And the answer is not really, but you can look at some trends. This is a really busy chart. I'm going to break it down for you really simply. The chart on the left basically shows 1-year returns after a time when the PE ratio was at 18.3 like it is today. Okay. And what you can see there is if you look at all those dots, each of them represents a 1-year return. They're all over the place. So 1 year from now, if I look at the PE ratio and say it's 18, that doesn't really tell me 1 year from now what it's going to look like because it's all over the place. But if I look at the same chart on a 5-year window, there's a lot more predictability here, right? There's a lot less volatility. You see a lot fewer negative returns over a 5-year period when the PE ratio is sitting where it's at. So we can't really predict with it, but it does give us some sense of how fairly valued the market is. Now, I mentioned an important part of PE is the E, or earnings, right? Ultimately, that's why we invest in the market. It's why we invest in companies. And so I want to look at another measure it's a related measure. It's called earnings per share. And you can think of earnings per share as same thing. If you look at an S&P 500 company or you look at a stock, what are their earnings compared to the number of shares that they have? And that's another value that we can look at. So this chart on the left shows a history of earnings per share. And what you can see if you look at this chart is that in 2020 and 2022, we had an earnings recession. But if you look at consensus estimates, the three columns on the right, the blue ones, right now the consensus is that we are going to see growth in earnings per share over the next few years. Okay? But here's what's interesting and what's kind of unique about this period in time. If you look at the chart on the right, and I know, again, you can look at the chart and you're right, you can probably go dizzy, but I'm going to try and break down, like, here's what you want to see on this chart. I want you to focus on this top little box. And the first thing you're going to see is an average. This is basically saying what makes up earnings per share. Where do those earnings, where does that come from? And historically, 4% of the earnings per share growth comes from revenue. 4% comes from margin or profit, which means I'm keeping my expenses down and I'm keeping my margins healthy. And a very small percentage comes from the actual share count. And think of it this way. If a company buys back its shares, it actually reduces the number of shares outstanding, and that impacts the earnings per share calculation, okay? Has very little impact. Here's the message here and why this is important. The average is that there's pretty much an equal weight to revenue and margin. But right now, look at 2023, that's not the case at all. There's much more weight to margin than there is to revenue. It's harder for companies, we're not experiencing, exponential revenue growth. So it's really important that companies keep their margins good, because that's really the primary driver right now of earnings per share. So the question then becomes, well, what do those profits look like? What do earnings look like right now? And that's this next chart. We're going to look at profit margins first overall for the S&P 500, and then we're going to look at some different sectors. And so if you look at this chart on the left, you see those gray vertical stripes, those shaded areas, those each represent a recession. And you can kind of see how profit margins were over the course of time. This chart is from 1992 through today. And you can see that while right now, first quarter of 2023, we're not the highest we've ever been, but profit margins are actually looking pretty good right now. And this is sort of the conflicting data that you get. On the one hand, you hear about layoffs, and I always wrestle with this. Like, you hear about layoffs, and you're like, oh, that's a terrible thing. The economy's doing bad. And of course, you think of the families that are affected. But if you look at it from a business perspective, what does that mean? Practically speaking, it means companies are reducing their costs and increasing their profits, right? And so that's kind of the double-edged sword of employment decisions like that. So right now, profit margins actually look pretty good across the S&P 500. And then we can also look at it by sector. And what you're looking at on the right here is the gray bar represents the range of profit margins that we've seen since the fourth quarter of 2010. That's what that gray bar represents. And then the green diamond represents where we sit today for each of those different sectors. And so what you can see is, largely with the exception of, say, real estate up here, consumer staples, we're either at or above or near the top of these ranges in terms of where profits are today. Okay, so that's good news for the market in terms of, if we see profitability, then that's good news for the stock market. Now that can change. As we know, it can change any day. But currently, that's where things stand. You can kind of see by sector how that stands today. Yes.
So move back up one slide. The three blue bars on the left-hand chart, you said that's projection of where earnings are going to go. And that, what I thought I heard you say, is based on improving margins, which is related to cost savings layoffs and so forth. Is there any other, that's crystal ball stuff.
Yeah.
So it may or may not be true, but that's best guess.
Yeah, so yeah, when I say that these are consensus analyst estimates, right? So what's an analyst's job? And an analyst's job is to go out and kind of dig into the individual companies, look at their financials and kind of say, all right, what are things going to look like going forward? So yes, they are simply that, they're estimates, and estimates can be wrong. If you've probably heard in a news cycle, the Dow Jones, is down, or the S&P 500 is down, and this particular company, reported that they didn't meet their estimates. That's what they're talking about, right? Like the market is pricing in an expected result, and if it doesn't get that result, then that's when you can see some of that impact. So, yes, good question. And if I didn't mention it before, thank you for asking, Lowell. Please ask your questions as we go. Right? We'll have time, as much time as you want for questions. Don't be afraid to ask. Don't be afraid to interrupt me. I don't have that much valuable to say anyway. So just jump right in. So I want to also look at value versus growth. So within the stock market, as an investor, you can look at value and growth as two different sort of approaches to investing. There are certain mutual funds that are value focused and others that are growth focused. And here's what that means very simply. If I'm a fund manager and I'm focused on value, I'm the bargain hunter, right? I'm looking for that diamond in the rough. I'm looking for that company that their share price may not be that high, but their financials look really good, or they've got a really good product coming out. And I like that company. I think it's underpriced, so I'm looking to buy that. Okay. Whereas a growth company is, if I'm looking for a growth stock, I'm looking for a company that's shown a history of growth, and I'm jumping on the bandwagon, right? I'm saying, hey, this company has done well and it will continue to do well, so I'm going to invest in that. So we look at value and growth because different sectors kind of fall into one of those categories. And it just helps us, if you look at your investment statements from time to time, you might see a value fund versus a growth fund. If you ever see that, that's what that's referring to. And we, obviously always look at a blend of those. We, want to make sure we're diversifying. But they tend to move in cycles. And so right now, this is a really busy chart. I don't want to spend a lot of time on it. But generally speaking, value funds, remember that PE ratio I started with? Value funds tend to have a really low PE, and growth funds tend to have a little bit higher PE ratio. And you can see that at the bottom. The current for value, remember the S&P 500 average is 18, right? 18.3. The current PE ratio for value stocks is 14.5. And the current PE ratio for growth stocks is 24.2. So what that tells you is, from a valuation standpoint, growth stocks have had a bit of a heyday rate lately. Value stocks are a bit more of a bargain right now. And you can see when you look at the long-term average, comparing it, the lower on the chart you are, the more you want to emphasize value over growth. Now, that doesn't mean that, now it's time to go into value, so we just get out of growth. And we don't make a lot of tweaks based on this, but I just like to let you know this is some of the stuff that we're paying attention to and looking at. And when we do make tweaks, we're making minor shifts here and there based on what we think is going to happen. And again, we can look at it by sector. So the one thing you'll note here is, well, let me first tell you what this chart says. What this chart is showing you is what is the impact on operating income from a 1% rise in revenues. Okay, so how much is profit affected by a 1% increase in sales or revenue? And so right now in energy, that gets an 8.4 times result. So energy, real estate, materials, financials, utilities, you see how those are all gray bars? Those are all sectors that are considered value sectors, okay? So whereas the growth sectors, you can see, fall at the bottom of the chart. So none of that is good or bad, but it just kind of, talks to, okay, as we're making allocation changes, where should we be looking, and what might be some sectors or things that we would be looking If you're invested with us, you have all of that in varying degrees, and it does move from time to time. But wanted to touch on that value versus growth. So let's look at a bit of history for the S&P 500. I'm going to venture to guess that most of you in this room have seen this chart. And the reason I'm venturing to guess that is because we use it a lot in our meetings. I love this chart because it's when we go through periods of volatility, it's a good reminder of a couple of things. First of all, 32 out of the 43 years on this chart are positive. Okay, so I know two things from that. Number one, 75% of the time, roughly, the market has been positive. Now I have a brilliant mind, so that also tells me that 25% of the time it's negative, right? Did you see the deductive reasoning there? So one of the things we often say, you know, when we look at 2022, we ended up the S&P 500 down 19% last year. That, you know, just because that doesn't always happen doesn't make us feel better, but it is a good reminder. We know this happens from time to time, right? That's expected. If we invest in the market, that's expected from time to time. And the good news is we've had a pretty good start to this year, even though it's been rocky, right? We had a great January. If I showed you this chart in January, this is as of April 18th. If I showed you this chart in January, it would have looked almost identical, not quite as high. And then we gave back most of it going through February and into the middle of March. And then late March through today, we've had, you know, some additional growth. And today, you know, we're sitting at 8% year to date on the S&P 500. The other thing that this chart tells us, the red dots on this chart represent the worst drop within each year. And on average, the market drops by 14% every year. Okay, it's already gone down by 8% this year. We made 8, and then we gave 8 back, and then we made 8 again. You can kind of think of it that way. So if we have a 14% drop in the market, that basically just means it's an average year. And some of the most volatile years in the market have actually been some of the best returns. So it's just a reminder to stick to a disciplined strategy. And it's also a reminder that, yes, 2022 was bad, but these 3 years weren't too bad, despite everything that was going on. And so I often tell my clients, if you want to feel good about your investments, just don't look at the 1-year number. Look at the year-to-date number, look at the 3-year number or 5-year number, and you'll feel much better about your investments. If you look at the 1-year number, yeah, you're not going to feel real good about that. But based on what we've seen, long-term things have looked pretty good. And in fact, let's take a minute to look at bull markets and bear markets and what they look like. Again, lots of numbers on the chart. I'm going to show you what you really need to know from this. The chart on the left is basically just saying, what return would we need to get in the S&P 500 to get back to where we were at the peak in January of 2020? Okay, or excuse me, the January of 2022, not January of 2020. So if from today or from April 18th, we got a 1-year return of 17.1%, we would be back to where we were at the peak of the market. If we got a 9.1% return for 2 years in a row, we would also be back. 6.6% for 3 years and so on. So it just kind of gives you an idea, like what would it take for us to get back there to where we were at the peak of the market? I think this is an interesting chart. It shows all of the bull markets since 1926 and the bear markets. This is what's interesting to me. If you look right at the bottom, the average bull market lasts 51 months or just over 4 years. And during that time, earns an accumulated 162% rate of return on average. The average bear market lasts 20 months. And the typical or average drop in that time period is 40%. Here's what's interesting to me, though, and I noted this when I looked at this chart. Can you see those numbers in the back, or are they a little small? Well, I'll just, if the average is 20 months and a 41% loss, I wonder what it would look like if you took out just these first 3 in 1926, 35, and 42. Because look at those, 32 months, 61 months, 36 months, 86% drop, 60% drop. those impact that average pretty heavily, actually. And so again, it's just a reminder. I often hear, and we all kind of have this tendency, I don't have time to make up, I don't have time to make up if the market has a big loss right now. And so I try to put that in perspective and say, well, on average, a bear market lasts 20 months. And even in the worst of cases like 2008, if we go back there, it was one of the 3 worst years on record. Even in that case, if you were diversified and you managed properly and rebalanced your portfolio, you were whole within 3 years. Okay. So I think we sometimes feel like, oh, if the market drops, that's going to cost me, like it's going to take 10 years to come back. Well, that's not what, historically the market has shown. Okay. So I like this, just again, a couple slides just to give us some perspective when we have a bad year like we did last year, to look back at history and see how things have typically played out. Okay. So the next thing that I hear a lot is, okay, we've heard a lot about recession, right? There's a recession on the horizon. The economy is, kind of on this downward slide, and there is definitely some truth to that and some numbers to support that. And I definitely do think that there is a recession sometime on the horizon. I just maybe don't think it's as imminent as we once thought. And so I'm going to show you a chart here that looks at the National Bureau of Economic Research is the organization that sort of looks at, and defines when we are in a recession. And they look at 6 factors, which you can see on the left. I'm not going to read them to you, but they look at 6 factors, and you kind of look at this chart. I hope you can see those colors, but basically red is bad, yellow is okay, and green is good. Okay. And so what you can see is, back here in this time period, November, December, in the fall of last year, things were looking a little dicey, and that's why you heard a lot more about recession. But when you look at these numbers now, first of all, the white just means we don't have the data yet. So if we look at the month prior, February, it's all green and yellow. Okay. So what that would indicate is that the risk of recession is probably low. And if it is, if we are going to experience one, it's probably going to be mild at this point. Okay. The other thing we look at is this economic surprise index. We talked about consensus estimates before. Hey, they're estimates. What can we glean from that? We don't really know because they're just projections. But this is basically just looking at our actual economic results coming in at estimates, above estimates, or below estimates. And when we look at this, currently we're sitting above, which means that more often than not, the economic indicators are coming back better than what the estimates indicate. Okay. Now, I always feel like when I share this, I'm not here to say, hey, everything's fine. Like, we don't know. I'm just here to share some data that's out there right now that kind of gives us a sense of how things are going. Okay. Another chart, another 4 charts here. These are 4 different measures. Each of them, these different measures are referred to as the 4 horsemen of a recession. Okay. So again, just some more specific indicators of some sectors that tend to be a little bit more cyclical. And what you can see on each chart, you see a blue line, which represents the average. And you can see the history, and you can see the blue dot is where we stand today. And if you look at all of these, residential investment as a percentage of GDP, slightly below average, but pretty close to average, starting to trend downward. So that's something to keep our eye on, right? Then we have business fixed investment as a percentage of GPA, above average and starting to trend upward. So that actually looks pretty good. Light vehicle sales, above average, starting to trend upward. Okay, that's good. And then this inventory to sales ratio, this is kind of a reverse chart. I actually wish they had done this differently because this is something we want to see lower numbers on. But you can see, again, still below average, but starting to trend up. Okay. So a little bit of mixed information, but overall, again, if I look at those 4 indicator lights, I would say, okay, yeah, there's some things to pay attention to, but not seeing anything that says that we're heading rapidly into a recession. Okay. Another interesting thing that we look at is consumer confidence. I'm going to show you a chart of consumer confidence. Now, I want to preface this by saying this is not something you want to rely on. It's not something you want to try to time the market, but it is an interesting study in what I might call behavioral finance. It's an interesting study in consumer sentiment. So this is the chart, and it's all over the board, but the squiggly line that you see going up and down is, you know, a measure of consumer sentiment. Okay. And again, the average over a long period of time is 85. Okay. And then you can see the blue numbers and the dates represent, you know, what was the subsequent 12-month return from that point. And here's what you can see. Again, looking at that little box at the top, there have been, on this chart, there are 9 peaks. And the average 12-month return after one of those peaks is 3.5%. And then there are 8 troughs, right? Eight near the bottom of the chart. And the average 12-month return on the S&P 500 following those is 24.9%. So, and currently, consumer sentiment, this probably doesn't surprise you, is sitting around 63. It's below average. Why is it below average? Well, A, 2022, B, fear of what's going on in the economy and potential for recession. So again, this is not a, hey, consumer sentiment, which is low, which means that you're going to get 25%, you know, over the next 12 months. That's not what I'm saying. But what I am saying is there is some history here that there's an inverse relationship between consumer sentiment and what the market actually does. The way I've often said it is when you think you know what the market's going to do, you probably don't. And I can give you 2 primary examples of that. And I'm just going to say this right up front. This is completely politically neutral. I do not like to talk about politics in investments because I think it distracts us. But if you remember, and this goes back a while now, but when Trump was elected, way back when, a lot of money was pulled out of the market, like on election night. You guys remember that? The headlines, like, and subsequently, we had like 11 or 12 consecutive months of growth in the S&P 500. Okay. Now, did what we expected to happen? No. Did a lot of people expect things to go differently? Yes. Is that to Trump's credit? I'm not here to talk about that. I don't believe that, but that's not what I'm here to say. Here's the second one. Anybody remember COVID? Right? March of 2020, we had a significant drop in the market. COVID was raging. What did you think was going to happen in the market over the next few years? If I went back to that one chart and said, hey, we're going to have 3 years of double-digit growth, would you believe me? No. Okay, so remember, when you think you know what the market's going to do, you probably don't. And that's why we stick to a disciplined strategy. And this is just another indication of that. This chart also reminds me of the Warren Buffett quote. You guys know what I'm referring to? Anybody ever heard Warren Buffett's quote on consumer sentiment? He says, I get greedy when people get fearful, and I get fearful when people get greedy, right? So basically what he's saying is, if people are thinking one way, I'm going to go the other way. If the general consensus among Americans is one thing, I'm going to go the other direction. So that's what that chart reminds me of. Okay, I'm going to pick up the pace a little bit here. So let's talk about inflation. That's a big topic in the news. We're going to talk about inflation and the Fed. So here you can see the 2 lines represent the CPI and core CPI. And core CPI just means inflation without food and energy factored into it. And you can see both of them had a significant peak. They're both on the way down. Headline CPI has come down quite a bit more dramatically. This is really what the Fed is after. The reason they have aggressively raised interest rates is they're trying to push inflation down. And inflation is coming down, but it's coming down a little more slowly than they like. And so it's very likely, in fact, tomorrow we'll be having another Fed announcement. I'm guessing they're probably going to raise interest rates another 0.25%. We'll see.
Can you explain the value of core CPI because energy and food are real world costs in all of this pay?
Yeah.
So why do they care?
I can't. I can't tell you why they don't include, like, why do we measure inflation in different ways? I don't have a good answer for that. It's kind of like when people ask me about why is the tax code written the way it is. I'm like, it is what it is. I don't know why it is, but it is what it is, and I will help you navigate that. But I will, the next chart actually, Lo, might speak to that a little bit. So the next chart is kind of, we call it a heat map of inflation, and it just shows inflation by different sectors. And again, you don't need to read the whole chart. You just need to look at the colors, right? And so you can see here in shelter, rent, medical services, we had a lot of red or almost red, but currently we're actually looking pretty good, right? Inflation is starting to come down, particularly energy has actually looked a lot better. You know, you've probably seen that at the gas pump. And so again, I don't want to give credit to the Fed, but if the intention was to drive inflation down, and inflation is coming down. Okay. And then the next thing is, okay, so what about the Fed? They're meeting again tomorrow. We hear an announcement on whether they're going to raise interest rates. I think it's pretty widely expected they're still going to do at least one more rate hike. This is looking at the history of the rate hikes, and then it's looking at, from here on, what is projected. And so you can see this little section here at the end, starting in 2021, very aggressive, very rapid interest rate hikes, more aggressive than what we've ever seen. If you look at the two periods previously where you saw kind of an increase, you see all those little steps, kind of little step, little step, little step, little step. Over here, you just see, big leaps. The most aggressive interest rate hikes we've seen. The Fed is basically suggesting that's probably going to peak out at around 5.1%. And then maybe by 2024, we're down to 4.3, and their long-term goal is to get back to around 2.5. Okay. So we'll see what happens this week. I think the market right now probably is anticipating another rate hike. So if they do 0.25%, that's probably not going to create much of a stir. If they choose not to, that could be a good thing for the market, but I'm not confident about. Anybody ever heard of the yield curve? This is a chart that basically just shows interest rates on US Treasuries from, like, you can think of this like a CD. How much does a 3-month CD pay compared to a 20-year CD? Think of it that way. US Treasuries are operating the same way. And so right now, the yield curve up at the top is inverted. And again, whenever there's been an inverted yield curve, that often spurs talk of a recession. Okay. Every recession in history has been preceded by an inverted yield curve. Every time. But not every time the yield curve has been inverted has there been a recession. You follow that? And when it does happen, it can be 20 months or 2-3 years later. So it's not a good predictor, but it does kind of show us kind of how interest rates right now, short-term interest rates are actually better than long-term interest rates on US Treasuries. The other thing that I think this chart that's fascinating about this, the gray line down here is December of 2021. The green line is December of 2022. What a difference a year makes. There's 2 to 2.5% or more difference between those two lines just in that short amount of time. Okay. So what's that done to the bond market, and what we're going to shift gears now. We've talked a lot about stocks. Now we're going to talk about bonds a little bit. What's that done to the bond market? Well, again, lots of numbers on the chart, but this is just looking at, again, kind of a valuation of the bond market. How attractive are bond yields right now? And across the bottom, you can see lots of different types of bonds. Again, the gray bar represents the 10-year range. The purple horizontal bar represents the average, or median, I should say. For you statistics people, I want to make sure I don't differentiate between average and median. And then the blue diamond represents where we're at now. And so the story of this chart is across the board in the bond market, valuations and yields are very attractive compared to their 10-year histories. So there are higher yields to be made in the bond market. I'm going to focus on one in particular just because it was interesting to me. Anybody familiar with municipal bonds? Investing in bonds with local local governments or, building projects or whatever else. Well, the interesting thing about municipal bonds is if you have money in a taxable account, if you're in a high tax bracket, municipal bonds, the income from those is tax-free. And so if you compare the yield of a municipal bond to the yield of a regular bond, if they're equal, the municipal bond is actually better because the taxable bond, you got to take the taxes off, right? And so this chart just kind of looks at, again, that same yield curve. It's on a different scale here, but you can see kind of the inverted yield curve for treasuries at the bottom. And then the blue, the dark blue, represents the municipal tax equivalent yield curve. So if you think of long-term municipal bond yields, and then you factor in, the tax savings on those, you can see there's quite a big delta there. That's an area that if you're in a high tax bracket and you're looking for what is a historically conservative investment, that's an interesting place to look right now. In our portfolios, we have tax sensitive portfolios for clients, and they often include, some allocation to municipal bonds in there. Okay.
Jamie, how would you define high tax bracket, top 2 tiers?
Yeah, so great question. The chart is actually assuming the highest tax bracket. So that's the first qualifier I want to give you. But yeah, I mean, I would say, anybody that's in, up above that 24% or whatever, it kind of looks at, you kind of have to look at where am I in the tax bracket now versus where am I going to be? And that's kind of an unknown. But yeah, I would say anybody that's up in that 25 to 30% or more range. That's a good place to look. I like this next chart. I showed you the history of the stock market, right? That showed each year's return. I want to show you the same chart for the bond market. Now, historically, the bond market has been our friend, right? When the stock market is going like this, the bond market is just even keel. It gives us a moderate rate of return. Sometimes it gives us a really good rate of return, but it's never super volatile. This is a very telling chart. This is the history of the bond market. Look at the red. Remember, the red dots represent the worst loss within the year. Look how consistent that is. It makes me feel good when I look at that across history. Worst loss we've ever experienced prior to last year, -3% in the mid-90s. What about last year? Like, does that look a little odd to anybody else? Does that stick out like a sore thumb? So this was the big issue last year for any investor. If you had a more stock heavy portfolio, a more bond heavy portfolio, both sections were losing double digit last year. There was no place to hide. And so that's why it felt like, you're looking at your statement. That's a big reason why it felt the way that it did, is because there was really nothing making money. Again, some recovery this year. And again, in the bond market, there are more attractive yields. So that's an area where, you can get some additional return. Okay, I'm going to wrap up here. I want to touch on one more area, and that's international markets. I sometimes get asked, why do we invest in international markets? Like, there's a lot of volatility there. There's a lot of uncertainty. It's a VUCA world out there, and even more so maybe in the international. I want to point you primarily to the right side of the page here. The left side is a bunch of numbers I don't really care about too much. So the reason why I think it's important to invest in international and have some exposure there, if you look at the global market capitalization, 60% publicly traded stocks are in the US. Again, if we put on our statistical hats, what does that mean? 40% is international. So if you're not getting any exposure to that, then I think you're missing out, and you probably have a little bit of concentration risk. And in addition, if you look at here, this is just showing you by country how much of the stock's revenue comes from within that country. And in the US, that's about 60%. So again, even with a domestic company, oftentimes 40% of their revenue might be coming from international sources. So for that reason, it's important for us to have some exposure there. Another reason is that US stocks and international stocks tend to, perform better at different times. Like, we go through cycles where US stocks will outperform internationals, and then we go through cycles where internationals will outperform US, and that's what this is showing. The purple sections represent when international stocks have outperformed US stocks. And the key takeaway from this chart is look at the most recent cycle. The average cycle prior to, right around 2008, the average cycle was maybe between 3 and 6 years. And then we had basically a period where for 14 years, US stocks were outperforming. And so, that has started to turn around. And so again, just a reason why it's important to have some exposure in those international markets and a little bit of history there. And then lastly, just looking quickly at valuations and dividend yields. I'm not going to spend a lot of time. This is a busy chart, but again, this looks similar to that valuation chart I showed you for the S&P 500. Valuations and yields in the international markets are very attractive right now as well. And so that's why, again, if you're invested with us, we have that exposure already. But I like to tell you why we have that. Ultimately, if we put it all together, I'm not telling you anything you don't know when I say it's important to be diversified, but I like this chart where it puts it all together. Anybody seen a chart like this before? Okay. This is an interesting chart to me. So from 2008 until today, it's showing you a ranking each year, which asset class did the best. Okay. And I defy anybody to pick out one asset class that, was the best every year. Oftentimes you see them, they're at the top of the chart one year, they're at the bottom of the chart. It's just a ranking of each of the asset classes by year. In essence, there is no pattern here that you can take. That's the message from this. But if you focus on the white line, that white line is a diversified portfolio, a balanced portfolio of stocks and bonds. And you can see it's not usually at the top, it's not usually at the bottom. It rides right in the middle. But if we look over here at the right, and we look at the entire time frames from 2008 to 2022, a time period where we've had good markets and we've had bad markets, right? And we've had really bad markets and we've had really good markets. In that time period, that asset allocation strategy, that diversified strategy, was the 4th ranked in terms of total return over that time period with a lot less volatility. And from a volatility standpoint, it was near the bottom. Okay, so again, just a message, why do we invest the way we do? Why do we tell you not move your things around, not panic? This is why. This is the proof that over the long term, it works in good and bad markets. And the last thing I'll show you is just kind of as we look at those same asset classes, I'm going to go back once more to the valuation of those asset classes. This chart is looking at a Z-score, and a Z-score is basically just a way of standardizing that different asset classes are measured by different numbers. And so this is just Z-score is a way of standardizing that and for comparison reasons. So again, the lighter green diamonds represent where we stood at the end of December of 21. And the dark circles, the green circles, represent where we stand today. And so you can see, and the 0 is kind of like the average. You can see across the board, we're at pretty good valuations compared to where we've been. Okay. Now, I mentioned the growth that we've had in the market, and I've mentioned, US versus international. You'll notice that the difference between those two isn't quite as high over here on the right-hand side of the chart, where we have US growth and large cap stocks. Values a little bit further over. Municipal bonds, look at the delta municipal bonds. It's part of the reason why I wanted to highlight that today. So just gives you a picture of where in the market the valuations are. So at the end of the day, again, none of this is a cause for us to make major changes in portfolios today. But I hope it gives you some sense of, all right, what do the numbers look like that we're looking at every day, and what does that mean in terms of the market? I'm not going to try to prognosticate, but I did want to share some information that helps you kind of see where things stand. Okay. Now I have a bonus for you today. In addition to talking about investments, I want to share a couple of ideas around charitable planning. Just some tips for you to be thinking about as you're going on your way today. But before I do, any questions on any of that market stuff that we just talked about that we didn't get to ask yet? Sure.
I don't know, this is the crystal ball type thing, I guess, with going back to your slide on energy, and it was way out there.
Mhm.
Given the situation today with wind, solar, such and such in the future, what do you think energy is that going to be a factor, or are people going to be investing in that, or corporations investing in that?
Yeah. Yeah,
And when's it going to decline? Because, you know, the industry as we know it today, based on oil and so forth, is it going to be that lucrative in the future?
yeah,
That's a real crystal ball.
yeah, yeah. So the first thing I would say, energy kind of falls into that commodity sector, and commodities can be very volatile, and they're typically not a huge part of our portfolios. It's always a diversifier, but we don't want it to be like a huge section of the portfolio. But I've been hearing, for years, we've all been hearing about green energy. And so, it feels like we're always ahead of the game, like, oh, you got to invest in green energy, but then, the companies they're not really profitable. And so but you're seeing a lot more of that. In fact, I learned this from my business partner, Jim, I think in one of these sessions. He was talking about Exxon and how, obviously one of the largest energy providers, and they've taken their lumps over the years, but they're also one of the largest investors in green energy. So I don't know the end, like, how is that going to play out over time? I think ultimately when we're investing in energy, we're investing in energy companies, which might be invested in oil and gas, but might also be have some diversification within the company in green energy, solar, wind, other sources.
I think they're going to have to continue to, because if you don't change, you're out of business. So
Yeah.
I think they're going to have to continue their investing. I just don't know if it's going to be as profitable as they've been.
Right.
It is volatile, but probably over the 20-30 year period, they've been probably pretty good.
Yeah.
Investing.
Yeah, they have to innovate. I think of the example of, the Kodak, the camera film company that said, oh, this, digital thing, I don't think that's going to take off, right? Or the newspapers, they're like, oh, people are always going to want to have a newspaper in their hand, and now newspapers are on the phone. Yeah, all of them, they have to innovate. And if they deny the fact that this is coming, yeah, the cab industry and Uber and Lyft, all of those are industries that have evolved. But ultimately, if you're investing in that sector, you're getting some of both. So, okay. In the interest of time, well, we're at 9 o'clock, so I'm going to keep this brief. I just want to share, investments are important, but we also like to share some ideas for you to be thinking about, specifically around charitable planning. I recently had the opportunity to write an article for a local nonprofit that puts out a newsletter to their donors. And they kind of gave me carte blanche, like, I'll just write about something financial. And so what I wanted to share is ways that you can give charitably from non-cash assets. Statistics show that 80% of the giving in our country comes from cash assets, meaning what's in our checkbooks. 80% comes from there. But in terms of where the wealth is, 80% of the wealth is in non-cash assets. And yet we don't always, use those to our advantage to give. We give from our checkbook, but we don't think of other ways that we can give from these non-cash assets. So I just wanted to share 4 ideas for you to maximize giving, if that's important to you, via other means. Some of you might be already doing this. Some of these might not apply, but I just want to share them so you can be thinking about them for yourselves or others. So the first one, how many of you have heard of qualified charitable distributions? Right? Okay, this is probably the most common. In short, if you are over the age of 70 and a half and you want to give money to a charity, or you already are, one of the best ways to do that is to give it directly from your IRA. Because if you have the money go directly from your IRA to a charity, as opposed to coming through your checkbook, that does not count as taxable income. And when you get to retirement, many people aren't itemizing deductions anymore. So when they give that gift from their checkbook, they're not getting a tax benefit. This is a way they can continue to get a tax benefit. We have clients use these all the time. So if that's you and you're not, that's probably a conversation that we should have. The second one, donating appreciated investment property. So let's say, you've got your IRAs and Roth IRAs and those types of accounts, that's all tax deferred, but some people have also investment accounts that are taxed as they go, right? They get a 1099 at the end of the year and they report dividend or capital gain income. And oftentimes those types of investments can have a large gain in, right? I bought it at this price, now it's worth this. If I do anything with it, if I sell it, I've got to report this big tax gain. What do I get? I want to diversify, but I don't want to take the tax hit. This could also be, by the way, it could be a stock, but it could also be rental property or something like that, real estate, land. So one of the things that you can do is rather than selling it and taking a tax hit, you can actually donate that property directly to something like a donor advised fund, which gives you a charitable deduction potentially. And it gives you, you don't have to pay tax on that gain. So this can be an alternative. If you're already giving from your checkbook, but you have these highly appreciated investments over here, maybe you want to give from those instead of giving from your check. That's just another idea. Doesn't apply to everybody, but something to be thinking about. The third one, naming a charity as your IRA beneficiary. We spend a lot of time talking with our clients about, where their money goes after they're gone and making sure that you understand the tax implications of different assets, because those tax implications might dictate that one asset should go here and another asset should go there. So, for example, if your children inherit an IRA from you, they're going to pay Pennsylvania inheritance tax on that, but they're also going to pay income tax on that. And they've got to take that out, over 10 years at most now. But if that money goes directly to charity, then there's no tax gain on that and there's no Pennsylvania inheritance tax. Okay, so just some ways to be smart about your estate planning and say, if I want charity to be part of my estate plan, then it's important to look at which assets are going to charity versus which assets are going to your kids. And the last one, I don't know if this applies to anyone, but it's something I want to talk through. I'll use an example of a client I have now who, whether you own a business or whether you own rental real estate, my client happens to own a few different rental properties, and we have put those properties into an LLC. So he has this kind of rental business. And while we haven't done it yet, what we've talked about is he actually can donate part of his business to a charity, to a donor advised fund. And, if he's not planning to give it to his kids because they don't want to run it, and he doesn't need it for himself, and he doesn't necessarily need the income, he can donate part of that business to a donor advised fund and still run the business and make all the decisions for the business. In essence, it's like he's in a partnership now. If he wants to give 50% of the shares of that LLC to a donor advised fund, now it's like he, the individual, is in partnership with his donor advised fund. And so if that partnership produces profits, half of those profits come to him and half of them go into this donor advised fund. So there's some cool things that you can do that help, again, save taxes, benefit charity. And I want to be clear, my goal is always to help the clients do what their goals are. But in that process, my goal is not to get more to charity and disinherit the kids. In a perfect world, we disinherit the IRS and we help the kids and the charity. And those are the strategies that we use. These are a few ways that we can do that. If any of those are interesting, I love this is like, I can talk about the markets, but this is what I really like talking about. So if any of that applies to you or friends of yours, we'd love to talk to you about that. Yes.
One clarification, talk about donor advised funds, for donating appreciated investment property. You cannot do that with QCB way. If I take money out of my IRA, it's QCB that cannot do it.
That is correct. Although there is I'll just leave it this way. There is a workaround for that.
Okay.
But you're correct. They have things called non-advised funds, which are kind of a way around that, but yes, generally speaking, they can't. QCDs can go to a donor advised fund. Okay, the last thing, this is the best part of the day. Just gonna walk you through a few slides of disclosures. I'll leave them up here for 10 minutes each. You can read them. No, I actually am gonna put them up here one by one, just so that I can say that I did and so that it's on our recording. Those of you, if you want to read this, this is recording, so you can go back later, go through all these slides in detail. Am I getting through them here? Then we've got some more. And this concludes our update. I will be around if you have other questions. Chris is here as well. Thank you for coming. Hope it was helpful. And if there's anything you want to follow up on for use for yourself individually, we're happy to do that too. And don't be afraid to grab more breakfast.
Thank you.
All right, thank you.